Good afternoon. Time to have a look at how markets are performing. Asian stocks declined as bond yields appeared to rise at this particular point. And this is again on inflation fears. Adding to that, the China Evergrande debt crisis that's continuing to intensify. Looking at how those markets closed, the Nikkei in Japan down 2.1%. Mainland China also saw some sizable losses. However, bucking the trend was the Hang Seng in Hong Kong, that up 0.6%. Looking at what's happening on the European market side of things, they happened to advance, shrugging off the fears of that rate-induced sell-off that we did see in the U.S. in the previous session. However, as we look at U.S. futures right now advancing, even though we still have the angst around the debt ceiling impasse that Washington is dealing with. But yesterday, the S&P 500 falling the most since May. And investors, of course, will be looking at how the rest of the week plays out with some of the central bankers taking center stage once again. However, to talk to us about the various themes and news that's coming out globally, we are joined by Chantal Marks, who is head of research at F&B Wealth and Investment. Chantal, looking at the JSE, I mean, probably 30 minutes into trade, it was little unchanged. How are we looking now?
Yeah, I was actually expecting the market to open slightly down today when I had a look at how miners were performing in Australia and how Tencent was performing in China. I think anyone would have bet that you'd have a pretty tentative start. But after about an hour, the market started pushing higher in line with European markets and also with US futures. And the best explanation that I could find from international analysts around those moves specifically were that the moves yesterday and the day before were probably a little bit overdone. And that fears around the impasse on the US budget also were overblown a little bit, because the word default has been thrown around quite a bit. And while we have seen an impasse on the budget in the US in the past, and it has resulted at times in a temporary government shutdown, we've never actually had the US default on their debt. And I don't think that we will see something like that happening anytime soon. So perhaps the market is coming to the realization that those fears specifically were a little bit overblown.
What are the implications of this impasse if the debt ceiling is not raised?
So if the debt ceiling is not raised in time, and that timeline has been confirmed by Treasury Secretary Janet Yellen as being mid-October, then you will see a shutdown in the US government. We actually did see something like that a few years ago. The idea is then to run a skeleton staff until you can get to a space where an approval of an increase in the debt ceiling is actually reached. The reason being that you'll actually start having a liquidity crunch if the US won't be able to borrow more funds. So it usually doesn't last too long, just because it's not in the best interest of Americans, it's not in the best interest of the US, and there's a lot of pressure from government employees and from society in general to get this solved. There tends to be a lot of politicking around it, so a lot of stops and starts in terms of negotiations, a lot of voting happening, and a lot of voting not necessarily coming to any sort of conclusion, but the probability of it actually resulting in a US default on its debt is pretty low.
All right, so when you talk of debt, I can't help but think of PPC. And the news out of PPC yesterday was that the rights issue almost off the table as its debt pile shrinks. And I was having a conversation earlier this week with Bright Kumalo from Vestec Asset Management, saying to him, the wonderful thing about the internet is that it doesn't forget, especially if you've done interviews talking about a particular stock. And I've got to go back 5 years into some of the interviews you've done around PPC. What can we make of the PPC story right now from the beginning when they, say, about 2015, 2016, when they had these big, massive expansion plans on the continent versus now? What's the story here?
So a few things happened for PPC during that time. I think the idea of going into the continent was a really great one. Cement was very much an underpenetrated market on the African continent. You had the big player Dangote, mostly in West Africa and then to a certain extent in East Africa. But certain geographies were very much underrepresented in terms of having a manufacturing base locally, and therefore being able to benefit from what was expected to be quite high growth in Africa and the rest of Africa, as well as necessary infrastructure expansion. Now, in certain areas where PPC went into, that actually did materialize, and I'm thinking specifically about Rwanda. But it's been a lot more challenging in a jurisdiction like the DRC, where you still have a lot of political instability, and a lot of country-specific issues that has resulted in not only the ramp-up of their manufacturing facility there being delayed and over budget, but demand perhaps not picking up as quickly as expected. They've also been pretty quiet on Ethiopia, so I suspect that things haven't been going as well there as they did in Rwanda. But what happened in the DRC specifically is that because of those overruns, because of those delays, and because of the disruptions to expected demand for cement sales, you actually saw debt balloon quite substantially. And that had a negative impact on the South African balance sheet as well. In South Africa, you also had a situation where we continued to see import dumping from countries like Pakistan of cement, local demand being quite weak. We know fixed capital formation both in the private and public sector has been quite poor. A lot of factors resulting in PPC really being unable to deal with its debt pile. What we've seen now, though, is that they've managed to restructure and kind of almost separate the debt within the DRC structure, the dollar-denominated debt that was a real problem for them. They've also negotiated new facilities with their South African lenders, and they've sold a business called PPC Lime and fetched about 500 million rand for that, which has reduced some balance sheet pressure for them. And it means, importantly, that they won't have to raise capital. I think the outlook for PPC and for the cement market generally in Africa is still quite positive just because of that infrastructure backlog, but volatility can be expected to persist. These jurisdictions are challenging to operate in, and in South Africa we're still dealing with dumping, even though I think that the infrastructure rollout here could start gaining traction pretty soon.
All right, Chantal, thank you so much for your time. That is Chantal Marx, who is the head of research at FNB Wealth and Investment. Of course, tomorrow we've got an interview with the CEO of Capitec. Again, they're going to be releasing their financials, so we'll have that for you and continue to monitor what is happening globally with markets. That is it from me. We're going to take a quick break, and when we come back, we'll have more news for you.